There we go. All righty. Good afternoon, everyone. Welcome to today's webinar. Today, we're going to be covering tariffs and M&A. I say Trump's tariffs, given he sits in the White House, being outside DC. He's talked about quite frequently in my part of the area. But without getting political, we're going to be covering small business M&A as it relates to tariffs. So if you're looking for a business new to the ETA space, or work in an acquisition team in your corporate W-2, this webinar is going to be jam-packed with some insights about what to think about in tariffs. There's a lot of noise around tariffs. The media and the news outlets love to talk about it. So we're just going to kind of double click and hone in on some of the key areas and things to think about as it relates to small business M&A. This is primarily going to be geared towards prospective business buyers and capital groups. So very excited to have you all here today. So nearly 60% of small business owners are somewhat or very concerned the tariffs are going to harm their business. What does that mean in terms of US buyers? When their sentiment when there is hold on one second, technical difficulty. I'm actually going to launch a polling question to see who we have in the audience while we work through the PowerPoint slides. So where are you in your business search process? Under LOI, actively searching, or just started searching? Who's in the crowd today? Don't be shy if you're just new to the space. There's a lot to unpack. Happy to help welcome you to what is small business M&A. So it seems like one person is under LOI. About half are actively searching and just started searching. So welcome. For the folks new to the search, hopefully this informational session will be jam-packed. For those actively searching and under LOI, double click on some of the key areas when we talk about M&A specifically. But again, welcome. So let's see. There we go. I think we should be underway. I think I need to go full screen. Okay. And if you have any issues with the slide deck and you can't see, feel free to write in the chat. I want to make sure everyone can see and hear me loud and clear. I'm happy to pause as needed. So just let me know. So the sentiment around small business owners from a recent poll was they're concerned the tariffs will harm businesses. So what does this mean for US buyers? When there is uncertainty in the market with owners, economic concerns, etc., overall, and what I'm seeing today is there's a hesitancy towards owners to start listing their businesses for sale. So as we head into Memorial Day weekend, in the near term, there has been talk amongst the M&A community that business listings are overall down. new listings. So if you're searching for businesses and you see that, you're not alone. I see that in the market right now as of today. And that very well could be due to this uncertainty of tariffs and these small business owners being concerned about really the material impacts of their business and less concerned about selling their business or working with brokers and checking the boxes to make their business ready for sale. So that's what like sentiment sort of and the narrative often dictates as it relates to M&A. That's something that I see quite frequently. So, you know, what are tariffs and what's like the financial impact without oversimplifying it? The majority of it is for small businesses, it relates to the impact it has on goods. And the impact it has on goods is really the expenses of some of these small businesses. So if you're importing from overseas, such as China, there's plenty of manufacturing facilities and plants for small businesses which make affordable products in China. All of a sudden, these costs of goods sold are being doubled, tripled, or materially impacted. So that is a direct impact on bottom line for some of these small businesses in manufacturing, et cetera. So when it relates to small businesses, the small businesses, they bear the brunt of these costs. They often will have to absorb higher costs to maintain some of these relationships. So when you're thinking about prospective buyers and speaking with owners, you want to understand. Hold on a second. What's going on with this? Apologies. 1 second. Let's see what's going on. There we go. All right. I think we should be good now. Sorry about that. But when we think about what tariffs really mean for your business, there's a few things you really want to focus on when you're talking to these small business owners. And that is really the valuation and the pricing strategies. So if you're looking for a business, you want to understand these price adjustments into your deals. So if there is, manufacturing businesses, for example, saw 54% price increases. If you're under LOI or actively searching a business in this space, you want to understand the dollar impact some of these tariffs are having on this manufacturing business. On the flip side, you want to understand, is it one party? Is it your primary plant that's experiencing this increase? And then what is like the go forward impact? The challenge with tariffs is it happened pretty rapidly with the new administration, and there is minimal visibility into when some of these tariffs will be finalized. It seems almost on a week to week basis. The administration makes these changes, and in small business acquisitions, this poses a challenge because without clarity, a lot of these small business deals won't close. So it's important to understand some of these dynamics when you are, thinking about submitting letter of intents for these small businesses. So what is the supply chain, and why does it matter when you think about analyzing these companies? So I always like to do an exercise of supply chain geography mapping, and the purpose of it is to identify um, the source countries of where the company's inputs are coming from. Is the company making all of its goods in the United States? Is it being uh, are the goods being produced in a number of countries? From there, if it's, for example, made primarily in China, you want to calculate some of the cost scenarios and determine the financial impact of tariffs uh, based on like today's rates. Uh, these cost scenarios will begin to, uh, if you're developing a three-statement financial model, you can start developing cost scenarios for tariffs if they were to stay, in the short term, long term, et cetera, to at least gauge if this business is viable under the current tariff environment. And then you assess uh, where you go from there. Does it impact the valuation? Do you use your cost scenario calculations, which can be produced in Excel or a Google Sheet? Do you take those cost scenarios and do you bring them to the seller and say, hey, based on these numbers, this is what your pro forma financial statement is going to look like. This is the expected profitability. And because of that, I may need to offer less, or we may need to restructure the agreement um, based on what was originally agreed upon in that letter of intent. And all of this mapping and research is really to answer two questions. One, can this business support a SBA loan or private debt in today's market based on these tariffs? And if the answer is no, how do we restructure the purchase agreement in order to align buyer and seller incentives and still close the deal? Um, the good news with tariffs is it seems like it's just this focus of this administration. In in 3-ish years, Donald Trump will no longer be the president. So there's no guarantee these tariffs will remain intact. So if you're under LOI or actively searching for a business, this is something, and this geography mapping is certainly something you need to put into your financial models, understand the potential impact, if any, just to be aware of it in the short term. I post and frequently comment on the J curve, which, for those of you who don't know, the J curve is effectively when a new business owner steps in, there often is a curve where the business trends downward for a period of 30, 60, or 90 days. So it experiences short-term declines in profit, revenue, et cetera. With this added tariff implication, I've started to see in the short term significant J curve impacts for new business buyers. Why does this matter? If you're actively searching and you buy a new business, the primary objective is to sustain business operations from the day one of when you take over this new business. Certainly, you will have some sort of J curve, but to the extent you can limit this J curve to maintain operations is best practice. Unfortunately, I've seen some horror stories of people who have had such significant J curves in their first 90 days as a business operator. Unfortunately, their business had to close, which is a horror scenario for those of you seeking SBA loans because you personally guarantee all your debt. So the point of the tariff discussion is you need to understand the cost implications for the business and put these scenarios into your models to make sure your business debt, whether it's traditional or an SBA debt, can support this new environment. So this was the original tariff announcement. I know based on keeping up with it through media, these rates have changed. But this, I did like this graph because it just shows that there's tariffs being applied like across the globe. So unless you are primarily um, creating goods within the United States, you likely have some impact of some of these tariffs on this small business you're looking to purchase. So keep this in mind as you're navigating. Certainly, there are businesses that have no implications around tariffs, which is wonderful. But in large part, there are almost every business which the small business community is looking to purchase will be negatively impacted in the short term. So let's break down a couple key areas. So when you're thinking about, okay, I've heard a lot about tariffs. What do I actually do in practice? Um, the first is contract analysis. So when you're conducting due diligence, it's best practice to do some sort of contract analysis around the supplier contracts, some of the agreements, clauses, and then some of the term lengths. As it relates to tariffs, you want to examine the price increase limitations and identify if there's protections against suppliers materially increasing your contracts immediately. There may be stipulations where uh, there's some pricing control or there's an agreed upon price in your contracts. Understanding these contracts and your assessment is critical. If you're actively looking at prospective companies, you can start to ask some of these thought-provoking questions in the form of you could ask the business broker or the owner you meet with, hey, how's your business handling the tariff issues? Um, if they aren't able to give clear answers or they say everything's going fine, I would recommend double clicking on areas like, have you had any price increase to your supplier contracts? Have customers, um, have you been able to pass along some of these customer, tariff costs to your customers? Um, Looking at some of those agreements, if you're unable to get concrete answers in, speaking with the owners, you could look at the P&Ls, the monthly financial statements. If, for example, your cost of goods sold all of a sudden begins to dramatically increase, my inclination would be that this company is impacted by tariffs or something in their cost structure has changed. So that's kind of how you think about it. Ask thought-provoking questions to the broker, but if you're not getting clear answers, the numbers never lie. So start looking at those monthly financial statements and do a detailed analysis to see some of the cracks in the story. So what's the export retaliation risk? When I say that, what I mean is um, you want to evaluate the exposure of the target business to countries implementing some of these retaliatory tariffs. For example, I like to bucket it in three categories. You have high risk, medium risk, and low risk. Low risk profiles, in large part, won't materially impact whether you're going to purchase this business or not. I would say that the primary risks are in these high risk areas. So if you uh, are pursuing a company that manufactures in China, that this is a high risk. Um, you need to extensively diligence the price increases, where the manufacturing plant is, what's the plan, and you need to very likely restructure your agreement if you have high risk exposure for these tariffs. Uh, how am I doing that in practice today? So with a few clients who are pursuing business acquisitions, which do a lot of work in China, um, we have paused closing on the business, and it's a wait and see until the tariff issue is resolved. Um, in large part, this is just a risk mitigation strategy. Unfortunately, without a clear sight, some of these business deals are too risky to close at the current valuation. Um, as a prospective business buyer, it ultimately comes down to your risk tolerance. If you are willing, have a higher risk tolerance, you may have conviction that these tariffs will resolve itself, and the business is what it is, and it's good enough to continue on. But if you have a more risk averse mindset, uh, taking a step back and extending due diligence maybe best practice. Because rightfully so, in my opinion, there is a lot of uncertainty around tariffs. Uh, and until we have a clear view, it's hard to close on a lot of these deals. Um, medium risk. So if you have indirect exposure through customers, for example, if there's a 5 to 15% impact on a component of your supply chain, a deep dive analysis of the customer base may be an important exercise to conduct. Uh, when evaluating acquisition targets, you want to consider this geographical diversification and incorporate some of these tariff impacts into your financial models. So, what are some deal structure tools? So, if you're actively searching for a business under LOI, what are some of the tools in your toolbox as it relates to deal structuring you can use for tariffs? So, what I'm seeing in practice, and what I'm recommending, is to set aside an escrow or holdback mechanism of about 10 to 15% of the total purchase price for tariff related cost overruns. What I mean when I say that is if the business is significantly exposed to potential tariff costs, which may be unknown, setting aside a 10% escrow to be used in the event tariffs increase or the business materially changes could be best practice. This escrow amount needs to be liquid cash, so you as a buyer can draw on it in the event one of these mechanisms triggers. If you're going to incorporate this into your purchase agreement, work with an M&A attorney to think about how you structure this holdback mechanism the right way, and then speak with the seller's counsel to really to make sure that they're on board and understand the mechanics behind this. Another tool you can do is contingent consideration. So if you're pursuing a small business acquisition and going to use an SBA 7A loan, um, you can use contingent consideration in the form of a seller note, um, or a standby seller note to tie certain payments based on financial milestones. In SBA land, you're not allowed to use an earnout, but you can use similar things such as tying future performance of top line revenue uh, over 12 to 24 months, and this allows you to protect some downside risk in the event your business is negatively impacted by tariffs. Um, You can add in tariff-specific clauses. So you can include termination rights if tariffs exceed specific thresholds. You could use language such as if the business loses X customer, um, the seller note is no longer due. You may lose that customer due to being required to raise prices due to tariffs. So if your number one customer has its primary good made in China, if the China tariffs force you to raise their prices by 30%, um, you may need to raise their price by 30%. So what you can do in a mechanism I see in practice is uh, tying the stipulation that you as the business maintains that customer going forward, and if it doesn't, the seller note is no longer due. That's a scenario you can use to protect some downside risk. So what are some targets I'm seeing, in the market? And the at the end, I'm going to pause for some questions. So if you have any questions about, how do I buy businesses, et cetera, feel free to drop those in, and I'd be happy to take a look at them. So domestic manufacturers are seeing significant issues in today's M&A market, given if there's production being made outside the U.S., if they have a secondary facility in China, they have some significant issues as of today. Um, Things that, businesses that aren't producing anything, such as like digital services, they face minimal tariff exposure. So if you are new to the business buying space and you're thinking, hey, what kind of business do I want to buy? I would recommend focusing on things that aren't related by tariffs. Um, you know, Without direct tariff exposure, it doesn't make a difference where these tariffs go in the market. So it would, if you're new to the space, I recommend that right now, just because there's less uncertainty. Um, and then targets with diversified supply networks. So businesses with multiple supplier options um, have advantages against, some of these tariff disruptions. So if the business produces revenue digitally and with production, they may have, a smaller negative impact on these tariffs. So what does the integration plan look like for, some of these new business owners? So if you've identified the supplier diversification, you want to identify and qualify alternative suppliers from some of these non-tariffed countries. So this applies to when you're analyzing these businesses, you may be able to identify alternative suppliers from maybe US based countries or countries that aren't negatively impacted by tariffs. After your detailed review of this contract negotiation, you want to think about, what does this relate to my customers? Like, why, what's the impact? If the business is heavily relied upon inventory, thinking about inventory optimization, building out strategic inventory buffers for some of these critical components is key. Um, I've seen in practice, uh, before the tariffs were announced, many small businesses were ordering large quantities ahead of time. So if you're looking at a prospective business and you see a large amount of inventory purchased, I would ask the question to the sellers and just gain clarity. Some businesses may have gotten ahead of it and have built up inventory reserves, which can sustain them for the next 6 to 12 months. Uh, Buying inventory ahead of time has its unique set of circumstances as it relates to deal optics. Typically, in small businesses, a lot of owners will want you to pay for the inventory or pay for some of the assets of the business, in addition to a multiple of earnings. If there's an inventory component to your deal, work with a trusted advisor or a CPA M&A accountant to understand what inventory looks like and how it relates to your deal and ultimately the price you pay. Um, and then develop a pricing strategy adjustment. Implement new pricing models that account for some of this tariff volatility. Set up good, better, best scenarios, maybe a worst case scenario of how your business or prospective business is impacted by some of this volatility in the market, and plan accordingly. Um, Without proper planning, it is very challenging to get ahead of some of these things. Uh, so that's some of the best practices I see. So continuing on, uh, this speaks to what we're seeing in today's market. And I kind of led with this, and I saw this graph and kind of thought it was helpful for today's discussion. We're seeing a significant deal signings fall to a 20-year low. Whether this is related to the broader market or just S&B, it's hard to tell. But this may be due to some of this uncertainty. This report was compiled on April 30th from Reuters. And while I anticipate deals to continue this trend in the short term, I do expect some pickup in the fall and Q4 of this year due to hopefully more certainty in the market around tariffs, where we're going, and hopefully more small business owners will agree. So if as you kind of think about your small business search, understanding where you are in your search and how this impacts you is key. I always say small business acquisitions are a marathon, not a sprint. So if you just continue with your search and remain diligent, it's very likely you'll be able to buy a small business. So for those new to the space, feel free to bookmark this and screenshot it. This is a typical timeline of what it looks like. So for the folks who said they were under a letter of intent or actively searching, typically once you sign a LOI, it commences what is called your due diligence period. So your due diligence period is typically 30, 60, or 90 days where you conduct comprehensive financial diligence, uh, bank underwriting, tax legal due diligence, and purchase agreement to complete your small business. So you will go from uh, you know signing your LOI, and hopefully on day 90 is the day the transfer of ownership occurs. I use this chart for all of my clients to show the necessary steps and parties that make up your deal team. Uh, for those just joining, I lead the financial due diligence practice of O'Connell Advisory Group. We're a boutique CPA M&A firm that focuses on financial due diligence for entrepreneurs and investors in small business and lower middle market M&A. I help you with clarity to buy the right business on your terms. We think about tariffs, working capital, and ultimately it's to develop a narrative and arm you with the tools and confidence to buy the right business. There's a lot of literature that the price you pay sets yourself up for success. especially when you're buying a business on a multiple of earnings, 3 times, 4 times, 5 times, 6 times. If you don't understand the normalized level of profit, you may very easily overpay for your business by $1 million, $2 million, $3 million. And ultimately, if you overpay for your business, there's a high probability you will struggle to meet your debt service for your SBA loan. So that's the point of what financial due diligence is. If you would like to meet me, feel free to shoot me a message or hang around after if you have questions about it. I also work with a handful of other partners, such as SBA banks and M&A lawyers who make up your deal team. I'd be happy to meet with you and discuss your deal. So, what are some of the key takeaways of this tariff risk in this M&A? It ultimately requires a enhanced level of due diligence. You need to do your mapping of the supply chain, understanding where uh, the specific business uh, is exposed to some tariffs. Where are they producing their goods? Where are they selling their goods? Analyzing some vulnerabilities and some of the provisions as it relates to tariffs. If you're not comfortable with developing roadmaps and understanding, tariff exposure, this is something, myself and my team do on a daily basis in today's market. Um, it's helpful to see from a numbers and, a dollars and cents perspective, if there is impact and if there is, what should you do about it? So happy to help as needed. From there, you want to develop a strategic valuation approach. So if there are tariff impacts, how does it relate to what you've submitted in your LOI for your purchase price? Again, running these stress test scenarios is key for some various tariff scenarios. Um, you can start with short-term analysis. For example, what are the current tariffs in today's market, and assume they continue on for the next, call it 6 or 7 months for the rest of the year. What does that look like if it continues for the next 3 years, etc. Uh, incorporate protective deal structures. So use contingent consideration clauses in the form of seller financing, which is a seller note, to align incentives and mitigate risk. The impact of tariffs should not immediately cause you to try to retrade your agreement. Oftentimes, if you are buying a business and you try to retrade, there's a high probability the deal will go sideways. From what I've seen in practice, I do say, as a rule of thumb, you can only retrade once. You have one chance to retrade from the time of LOI to the time of closing. If you're thinking about retrading, I recommend waiting until the very last minute where you have all the information, your quality of earnings is complete, your tax and compliance diligence is complete, and your legal due diligence is complete. From there, presenting the seller with the reasons and the support of why a retrade is the only way this deal closes is what I've seen in practice actually works. So if you want to take away one finding from today's webinar, it is that you only get one chance to retrade in small business acquisitions. So use that one free pass wisely. And then, this enhanced due diligence, your mapping of the supply chain, it really sets up for a nice integration planning. So imagine you've closed on the business, you've navigated some of these challenges of tariffs, negotiations, maybe a retrade, and you do get to the closing table. You can use this information which you've gathered in due diligence to set up a successful 100-day post-closing integration plan. I like to use a checklist for new buyers for this 100-day plan. And it really just shows a broad sense of how this business runs. What do I need to do? And what are the key areas I need to conduct on days 1 through 30, 30 through 60, and so on and so forth. So, as part of my webinar acquisition series for 2025, I have a few jam-packed sessions coming up, and I'm joined by exceptional entrepreneurs and business owners in their own right. So, next week, I'm going to be joined by uh, Daniel, who is the managing partner of Sweet View Partners, Inc. We're going to be covering uh, business sales strategies, how ETA buyers and sellers win together. Daniel is an exceptional entrepreneur in his own right. He buys, grows, and builds Texas businesses. So if you want to scan this QR code or the ones upcoming, it'll directly take you to the free link. Once you register, you'll get a free copy of the recording and all resources, whether or not you're able to attend. With that, I will pause for questions. Okay. So first question is when when should you approach a seller about tariffs if if you happen to notice that they may be impacted? So that's a good question. Appreciate the contribution. I like to talk about tariffs in some of these preliminary discussions when you first meet sellers and brokers, just to gauge the impact. Uh, I would caution you to understand the business and think about it before you ask the question. So, for example, if a business is not producing any tangible goods, it's very likely they don't have an impact. So, in order to present yourself as a reasonable and serious buyer, understand the business and some of the elements before you do ask these questions. If the business certainly is impacted, it is very appropriate to ask what are the implications, what is happening in the market, and what do you see the next 12 months look like? Hopefully that was helpful. All right, let's see. Got another one. The question was, when should we typically engage someone for financial due diligence? So if you're a buyer, once you have a signed letter of intent or LOI, I'd be happy to meet with you and discuss your project. Um, my comprehensive due diligence procedures typically take about 2 to 4 weeks. And once we have that signed letter of intent, we can develop and formulate a appropriate strategy to quickly, get through that diligence period so you can continue on with that 90-day roadmap, which I showed a few slides ago. Someone asked for, feel free to scan these QR codes and register. All right, another question. How are you thinking about tariffs in the long term? So I think in the long term, the tariffs will not materially impact some of the small businesses. I think the real risk right now is the uncertainty around tariffs and what they're doing to impact buyers, in the short term. For example, I conducted about 50 quality of earnings engagements and closed about 30 deals, 35 deals last year. Um, I speak and meet with some of these exceptional new business owners quarterly, and there's a few who have serious, significant declines in their business because of some of these tariff implications and economic conditions. Um, and when I ask them, what's the main issues, what's going on, it's really like the uncertainty and the inability to pass along some of these new costs to customers. Some of these customers are very price sensitive. So in reality, the business expense increases is a direct hit to their bottom line. um, Most of them have been able to weather the storm, but that's something I'm seeing in practice. Someone asked, any specific industries you do not conduct due diligence on? So I'm industry agnostic. So if it's a business in home services, B2B, and technology back, very comfortable with it. Um, I'm also assisted in the healthcare space by an exceptional partner who focuses on tax due diligence in healthcare. So if you have a deal that fits kind of any industry in this small business acquisition world, typically we can help. All right. Another question. How is working capital impacting tariffs? That's a good one. Um, the mechanics of working capital, which I talk about in other single webinars, it's not directly impacting how you are thinking about working capital in small businesses. For those of you who don't know, working capital is often negotiated in your deal. It's typically current assets minus current liabilities, um, excluding cash and debt. So if there's cash in the books, that stays with the seller. The seller then in turn pays off some debt. Um, in reality, in small business acquisitions, it is accounts receivable and accounts payables or salaries payable makes up the majority of this working capital. This working capital amount is delivered to you as the buyer at the time of close. And the reason it's delivered is you need a certain level of working capital to sustain business operations going forward. I like to think of working capital in the form of, buying a car. So if you're buying a car, uh, would you buy the car without the wheels or without the tires? Probably not. Would you want to buy a car that has no gas? Probably not. Uh, the point of it is tires on a car, gas in a car represents the working capital. It's the fuel to keep the business going forward. Where tariffs has impacts on working capital, um, there may be supplier issues with increases or you know changes in terms with customers or vendors due to some of this tariff related environment. So for example, they may want to reduce the term so it's a net 30 rather than it used to be a net 60. So this materially impacts your cash flow of the business. Um, Overall working capital should be calculated on a standalone basis in a tariff or non-tariff environment. All right, I think we have time for one or two more questions. So if you have any questions about a deal, small business M&A, or just kind of new to the space, I'm happy to answer one more question. All righty, one more. So this individual said, uh, how are you approaching uh, renegotiating the business purchase due to changes in the deal during due diligence? They also mentioned, you said you only get to retrade once. Can you just elaborate? So that's a good question, and I'm glad we can close on that one. Um, Retrading is the mechanics of it is when you submit a letter of intent, you say, I'll buy your business for $5 million. Um, that $5 million is based on your internal analysis and some of the profitability and multiple metrics you've identified before you conduct due diligence. Um, Once you engage a quality of earnings provider, and if there's instances where the business profitability warrants, say, a $4 million enterprise value, you're left with a significant challenge. Um, how do you approach a seller and say, you know what, I actually need to reduce my purchase price from $5 million to $4 million? Um, this is a very challenging area because it's a significant reduction in purchase price. So the way you do it is certainly you need extensive supporting documentation about why the business is now worth $4 million. Um, in practice, what I would recommend is showing them a quality of earnings report and saying, the business um, produced originally you presented $1 million of earnings um, at a 5 times multiple. Uh, that's why I issued and offered you $5 million because you said the business made $1 million. If you following the conclusion of your quality of earnings report, if the business is actually showing it only makes 800,000, you can show the calculations, understand some of the mechanisms of why earnings decreased, and then present these findings and say, I still want to pay you 5 times earnings, but your earnings are in reality only 800,000 and not 1 million. 800,000 times a 5 times multiple is $4 million. That's what I've seen work best in practice is a empathetic and logical reason behind why the business is worth less with sufficient supporting documentation. If you don't do these things and offer a retrade, it's very likely the deal, the seller's not going to agree to it because you haven't presented key findings. So work with a QOV provider, understand what normalized earnings looks like, and then make a decision how it impacts your deal, if it does, and what you should do about it. So that's all for today. Again, if you want to join me next week with Daniel or in 2 weeks with Kale or at the end of the month with Michael, I'd love to see you there. These are jam-packed sessions. And with that, I want to thank you for taking a little time out of your afternoon to meet with me. If you have questions which you didn't think of, feel free to message me on LinkedIn. I'm very responsive and willing to help. With that, I hope you all have a great rest of your day, and I'll see you at the next one.